Hi, it's Nick Stewart here, and in this video I'm going to tell you about the importance of tax structures and why the tax structure you buy an asset in is far more important than any discount an owner or a vendor or a developer can give you for the asset that you'll buy. So let's get into the video. Really interesting stuff here. Hi, in this video, I want to talk to you about why the tax treatment of the asset you buy is more important than the price that you pay or the discount you get from a developer or a vendor or whoever's actually selling you the asset. To give you a bit of background about me, I've sold real estate assets, for example, in 3 continents, South America, Europe, and Southeast Asia. And all those markets are very, very, very different. And the tax treatment in those countries are all different. And the way you want to buy that asset makes a huge difference to how your tax treatment will make a big, big difference. And probably more will be a bigger saving for you than actually any discount that you get. So I'd like to give you an example of that. So if, for example, if you were to buy a home, a second home in Spain, a lifestyle home, for example, I would advise generally, if the sale's under €1 million, would be to buy the property in your own name, because the tax treatment in your own name and the cost of running that would be much more beneficial to you than putting it in an SL structure, which would have bigger implications tax-wise and some unwritten laws. Once it's in a company structure, they tend the Hacienda in Spain tends to look at those more aggressively than they do in individual names. Also, you know, when you're doing Airbnb, for example, on your holiday villa, at the end of the day, how you declare that income to the Hacienda is your particular business, etc., etc. So, for example, in that case, we would always recommend that you buy in your own name up to $1 million. There are some such situations where it might be different. So you might want to do some inheritance tax planning, for example, and then there are other factors that come into play, which I won't bore you with the details now, but that can very much differ in which area of Spain you buy in. Okay, now let's take an investor, say in Hong Kong. This happens quite regularly. Who goes to the UK and he's buying a investment property on a buy-to-let basis. Now for him, we would always recommend that he buys through a SPV, special purpose vehicle, which is going to be a UK limited company owned by him or a holding company in Hong Kong. And the reason for that is very, very, very simple. Generally speaking, he will be taxed at 19% corporation tax. And by the nature of, because he's a non-resident of the UK, he doesn't have to pay income tax in the UK, and therefore he can take that money out as a loan. And there's many tax-effective structures he can do, which basically limits his tax to 19%. But actually, in reality, he can probably get his tax close down to zero. Now, if he was to do that in his own name, he would have to pay tax as a tax resident in the UK, and he could pay, if he had owned several of these units, he could pay up to 46% income tax. Not likely for one unit, but he would have that as an issue. Also, we would always recommend for these clients that they buy one unit in one company, so that you don't get hit by SDLT, which is another tax. When your group probably goes over 500,000, that can impact you. But if you have them as individual companies, then the tax burden is less. So there you consider, there's a good example of why, how you buy your asset is more important than a discount you can get. So you take this example, some person comes along to England and buys something in his own name and he gets 25% discount of the developer. He would have been better off going to another developer who had advised him to do this particular structure and pay 25% more, but he'd actually been financially better off. Now, it sounds crazy, but that's the whole beauty of making sure you do the right tax treatment when you're buying and selling assets. There are many more different stories when you get into the Philippines, in Southeast Asia, and when you get into Brazil, many different other things that you can do to mitigate taxes, especially in the Philippines where, for example, dividend tax, a bit like the UK, is much more favorable than personal tax. Anyway, I hope you found the video interesting. If you did, please like the video. If you have any questions, just put them in the comment section below. Be happy to get back to you. Thanks for watching the video, and please feel free to connect with me on my personal website, nickstewart.co. Really looking forward to hearing from you. Bye for now.